Hey, what's going on, everybody? Hope everybody's doing well tonight. Today, we're going to talk about Roth versus traditional. I know we've been doing a lot of talk about taxes recently, but the reason why we do this is because the questions that we get the most on our sessions when we're meeting with people always around taxes. Like we have what we call our retirement readiness form, and what that form does is we hit on five different areas that people are concerned around. One is income. We make you rate yourself, where you are when it comes to income. Are you 10, meaning you're okay with your income? Meaning like there's no you don't think your income will ever run out or your income will be too small as you grow older. One, you're concerned about it, right? We ask you those questions. Then the next we ask you around how you have your TSP invested. Do you think your TSP is invested in a way that you're confident in? Or 10, meaning you're very confident, you understand what's going on. One, you're not. And the third thing we ask about is taxes. And without fail, most people will come in around a one or two on taxes. So because of that, we make sure we focus a lot of these webinars on that because we want to, one, give you the tools to help you solve your own issues, right? The goal is we can't talk to everybody. We would like to, but we can't, right? But our mission is to help as many folks as we can to make sure that you can retire on time and with confidence. And so this is the reason why you might say, why are they always talking about taxes? The reason why we're always talking about taxes is because we see that that's the biggest question mark that a lot of people have. The next thing we always ask about is healthcare, right? How do you feel around your medical needs, right? 10, if a medical emergency happened, you're confident that you could weather that storm. One, if a medical emergency happens, it will derail your retirement. And then the last thing we ask about is legacy and estate planning. If something would happen to you, does your estate, the way it's currently set up, will your family be okay? Are they confident? Do they know where everything is? One, they're not. And our goal with Fed Legacy is to help you on all five of those things, right? We want to make sure we move you. We can't move you to 10 on all of them, but we want to make sure we get you from anywhere from a one down up to at least an eight. An eight is where you're competent, you have an idea of a strategy of what's working, and you're clear on those things. So our goal is to get you into an eight on all of those categories. And so that's based on those assessments that we ask everyone who meets with us. So if you meet with us by joining the link after this call or the survey after this call, you'll what we'll do is we'll take you through our discovery. And in that discovery, we ask you where you are on those five things. And our goal is to help make you an eight to a 10 on all of them. And so we've been helping federal employees for a lot of years master those five areas because those are the five areas that will impact you the most as a federal employee in retirement. Okay. Now, everybody doesn't have all issues with all five, but normally it's like one or two. And we want to make sure we get you to where you're competent on those. And so taxes is the biggest one. And so let's talk about what Roth versus what traditional is. Okay. Now, the question we always ask people when we're meeting with them is how much do you have in your TSP? And so when we ask that question, most people are like, "Well, I got 500,000, I got 700,000, I got 100,000, whatever it is." And then I say, "Well, what percentage of that is Roth TSP versus traditional?" Most times people say, "Well, I think all of it's in my traditional TSP." Then I say, "Well, then that means of your 500,000, really only 350 of that is yours. The rest is the IRS's." Why does that happen? Because with the traditional TSP or any traditional IRA, the taxes are not paid when you put the money in. You get a tax deduction when you put the money in. But what happens is that money, you pay the taxes, but you just pay it on the end. And so you get that tax deduction. It's great when you put it in, but then when you go to take the money out, the IRS gets the taxes on the back end. So that's how traditional TSP works. So you make 100,000 in as a federal employee, you put 20,000 into your TSP every year, or 10,000, 10, let's use 10,000 into your TSP every year, then your taxable income is $90,000 because you put 10,000 into your TSP. Now, that tax is deferred though. With the Roth TSP, that money you pay the taxes going in to that. And so then whatever you seize there is there. But if you make 100,000, you put 10,000 in TSP, you're gonna get taxed on 100,000. That's the difference. But when it comes to that though, the traditional TSP has been in existence since the 80s. The Roth TSP just came into existence in 2012. That's why it's so new to so many people. But when it comes to and one thing I also want to clear up, A lot of times people come and they're like, well, what's the max I can put into my Roth, right? Because most people are accustomed to having an outside Roth IRA. Now, when it comes to a Roth IRA outside of the government, there is a limit that's much lower. The limit when you're outside of the government is $8,600 as of today. It's $8,600 is the most you can put it into a Roth IRA outside of the government. However, when it comes to your Roth TSP, the same limit that your TSP has is the same limit that your Roth TSP has. So if you're 50 and above, you could put 32,500 into your Roth TSP. Now, if you're 60 to 63, there's a new rule that got put into play recently where you could actually put 35,750 into your into your Roth TSP or your traditional TSP. So in that 60 to 63, you're able to do the 35,750, right? And there's no income limit cap. So that's a big difference. When you're outside Roth, there's a cap. Inside the TSP, there's no cap. It's the same limits that you could put with your traditional TSP. That's a big deal because now you're seeing people who since it just started in 2012, you're starting to see people who have had their put them contributed money into their TSP for 10 years, 12 years, 5 years in some cases. And so they're retiring with these big Roth TSP balances, which is significant because it allows you to do a lot of things in retirement with tax-free money. Very important. So the difference again between a traditional TSP and traditional and Roth TSP is when put the money in traditional TSP, you pay the taxes right away. I mean, you get a tax deduction right away, but that money you pay the taxes on the back end. When you put the money in this Roth TSP, you pay the taxes right away. There is no tax deduction, but if you put it in there, and let's say your TSP goes to 100,000, that 100,000, not the matching piece though. I want to get into that. But I'm just saying the 100,000 that you contribute, all of that taxes are paid. That 100,000 can grow to a million. All that money you never have to pay taxes on again, no matter what it grows to. Super important. Super important to understand. And this is why a lot of folks do Roth TSP, put money into the Roth TSP, because they just don't want the IRS in their business. Okay. So when it comes to Roth TSPs, I got to explain the clock. I made a mistake. I was listening to the call last week. I made a mistake on somebody asked a question last week. If you start the Roth TSP, does that count with their outside Roth IRA as far as the clock goes? No, it does not. If you start your Roth TSP and you have an outside Roth IRA, those are two different clocks. So your Roth TSP clock is one clock, and you have and let me explain what I mean by clock. Anytime you put money into a anytime you start a Roth account, whether it's Roth TSP or Roth IRA, you have a 5 year window. You have to have the money in there for 5 years before you can take it out and benefit and reap the benefit of the tax free growth. Okay, you have a 5 year window. In that 5 year window, you could take money out, but you won't. You'll still get taxed on the growth. Okay, but if you have a Roth TSP and you started as your Roth TSP 5 years ago, and then you retire and you start up a Roth IRA outside of the government, you have a fresh 5 year window. Okay, now that 5 year window will count for any other Roth IRAs you do outside of the government, but you won't get credit for the Roth TSP window. The Roth TSP is its own separate window. So I want to clear that up because I was looking at the recording this week and I was like, oh, I misspoke on that. The Roth IRA has its own window. Now, one caveat, and this is coming up a lot because of last year with Doge and people retiring early. If you are 55 and you retire and you want to start doing Roth conversions, that I mean you're before 59 and a half. Every conversion you do starts a new window until you turn 59 and a half. So let me give you an example. Let's say you convert 100,000. Let's say you have 500,000, you retire to 55 and you want to convert 100,000 over to your Roth to your from your traditional IRA to a Roth IRA. That once you do that, that starts the 5 year conversion on that Roth IRA. But let's say a year later you want to do another 100,000. Now that 100,000 is a fresh 5 years. That continues until you turn 59 and a half. Okay. And the reason why that is because the IRS wants to avoid people circumventing that 10% penalty. So you have to be 59 and a half. But once you turn 59 and a half, that window stays the same. Now, for any Roth IRA, you do after that. So just so we clear, right? And so that's how that works when it comes to Roth IRAs in retirement. Now, when it comes to one of the driving points that is pushing a lot of people to Roth IRAs is the fact that RMDs, required minimum distribution. So required minimum distributions are important because at that point, well, it is an important thing to know about because once you turn 73, if you were born before 1959, then 73 is your window. If you're born 1960 and afterwards, your window is now 75, is when you have to start paying taxes on your traditional IRA. And so one of the things we always talk about on these calls is you have a window when you first retire, especially if you have to retire after 62 or 59 and a half, well, 59 and a half really. Um, but most people retire between 59 and a half or 62, right? And that's why I use those two numbers. But when you retire at those ages, your taxable income is less than what it was when you were working the year before. And so from that point until your RMD age, whether it's 73 or 75, that's ideal time to start converting money into Roth IRAs because at that point, your taxable income is the least it's going to be. Why does that matter? Because the higher your TSP grows, and it will grow in most cases if you're investing it right, it will grow as long as your income is going to grow too because you're getting cost of living increases. And so once it comes time to do your RMDs, requirement of distributions, now you're forced to take income from the TSP. And when you do that, or large, not even say income, but you're forced to take withdrawals. And when you do that, that can push you into higher tax brackets. What does that mean now? Now you might have been in the 24% tax bracket. You now might go to the 32% tax bracket. That's significant because you also pushes you up the state tax, your local state tax, plus your federal tax. Now you're paying 38% on taxes on money you could have paid 22% in taxes if you would have done it earlier. And so you want to make sure that and the money that you paid the taxes on earlier, as that money continues to grow later on into life, it gets bigger and bigger and bigger, and the taxes are done. We talk all the time about the 10-year rule with the kids. You especially as your balances grow, it prevents your kids going into those 40% tax brackets when you consider the federal plus the states. So there's a whole lot of benefits of taking advantage of what we call the the tax window from when you first retire to before you do RMDs. And you want to do it with some level of structure. And that's one area that we definitely will support you on. And so another thing when it comes to this topic that's really important when it comes to Roth conversions is you want to understand IRMA and Medicare. Super important. And so when you're doing conversions, and why I will advise you to seek some level of support when you're doing these conversions is if you're taking Medicare, if you're taking Medicare, especially Part B, there's an income limit, right? Now there's a 2 year look back, and I get this question all the time when they talk about the 2 year look back. What happens if I'm working and then I retire? Do they take the 2 years that I was working and and apply the premiums to that? So they will if you don't do anything about it. And that's something that I've been seeing a lot. And I've only had one person come to me with this already done. There's a form you can fill out. It's Form SS44, SSA 44. And what it is this, especially if you're retiring this year, you want to make sure you look up this form, plan for it, so that you can it's considered a life changing event when you retire. Now they're not going to reach out to you and tell you this, but they will take care of it if you submit the form. Oftentimes people just don't know to submit the form. Like I said, I've only had one person come to me and say, "Hey, I've already submitted this form." Most people wait till we have to tell them to submit the form to do it. And so if you retire, you qualify for a redo, right? And so what they do is they'll relook at what your fresh number is, not the 2 year look back. Okay. If you retire, which you all are doing, you just got to make sure you do it. You have a cut back an hour. So let's say you're working in the government and maybe you get a contracting job now. You didn't retire all the way, but you reduce your income by significantly. That also qualifies. You don't have to be fully retired. You just took less pay, but you want to match it to the current pay, not the 120 or 150 that you were making in the government. You want to match it to the lower pay that you're currently getting. That qualifies. If you get married, that matters. If you get a divorce, that matters. You just have to submit the form, and they will match your they will match it to your current reality. Now, what doesn't count though is if you do $100,000 Roth conversion or $80,000 Roth conversion that gets taxed as income, and they see okay, let's say you make 100,000 and you do a conversion of 80,000. Now your taxable income is 180, and you say, "Well, but it's not really income. I just transfer money from my Roth IRA." They don't care about that. That gets that gets calculated, and that pushes you into that higher earner premium. So you want to be careful when you're doing those, or just it just or plan accordingly income wise, so that you know exactly what you're doing. I've seen people do it, try to undo it, like, oh shoot, I went a little bit over, and you just want to make sure you understand what you're doing when you do it, because there's a whole bunch of little rules tied to it, like how much of the tax bracket um, do you take up? What was your income before? There's a whole lot that goes into it. I won't go into it on this, but what I'm saying is you want to make sure you have a plan when you're doing the Roth conversions, especially if you're taking Medicare. So, and I'm not going to be here to tell you. I think that's next week's session where we talk more in detail around Medicare, um, FEHB. We go deeper into that stuff next week. But if you want to book a call with us, that's some of the stuff that we go over when we're talking about Roth conversions and things like that. I think we're at the 10-minute mark. What I want to do is I want to leave time for questions, because last time we went over, and I cannot go over today because I got a session right after this with someone, and then I gotta get with the family. So any questions that I can answer right now would be great. What's the best TSP option for someone that has over 8 years left in government? Well, I don't know your situation. I would say this. Well, if you look at your TSP, if you look at your TSP, I mean, the life cycle funds are the safest. Make sure you match it up to when you're going to retire, right? That's the safest option. If you want to take a little bit more risk, you can lean more heavily towards the CSI funds. Um, those give you the best returns. And then once you get closer to retirement, what people tend to do is switch it back to a more balanced approach. But with 8 years, you can tend to be a bit more aggressive. So if you're an aggressive person in general, well, not you don't have to be an aggressive person, right? But if you are someone that wants to catch up, so to speak, then you can afford to take more risk. Then CS and I are good funds to look at, um, because they have the most return. But then the closer you get to retirement, you can kind of tone it back a bit. But 8 years is enough time where you can be aggressive and not really worry about the ups and downs of the market. Hope that answered your question. Without, I can't just tell you what to do because I don't know your situation, but that's a good rule of thumb to think about. um, okay, what if I'm only a few years from? Can I still convert without wrecking my? So if you're a few years out from retirement, if you're a few years out from retirement, converting inside of the TSP uh, can be convoluted because the TSP doesn't. They require you to pay the taxes out of pocket, and while you're working, is not really the ideal time to start doing conversions, because when you're working, you're already making a nice size income, and so when you convert, the taxes go on. I mean, the conversion goes on top of your income, so it's really easy for you to get into the higher tax brackets by doing conversions while you're working. Like I had a lady recently, and she came to us and she said, "I just did a conversion last year. I didn't know what I was doing, but I transferred 100,000 from my traditional TSP to my Roth TSP, and I got a $20,000 tax bill, and I didn't know what I was doing. I should have never done that." And I was like, "I'm not gonna say that, but you should have thought about it some." And so we saw a lot of that when the Roth conversion window first opened up. But you want to be strategic in how you do your Roth conversions, is all I will say about that. Any other questions? What percentage of your TSP should you go convert into a Roth IRA? Kenny, it just depends on your situation. So we like to look at it like this, Kenny. Well, let me ask you this, Kenny. What's your age, Kenny? And don't worry, we're not gonna put your full name out there. But what's your name, Kenny? I mean, what's your age? All right, Kenny, if you're above 59 and a half, right? Then when it comes to your because the question you asked was how much did you convert to a Roth IRA? We like to look at no more than 7 years of conversions when we start doing a Roth conversion setup. Meaning, let's say we take X amount of money. Let's say we have 300,000 that we want to eventually convert to Roth. Okay, you're 55. So are you retired, Kenny? Though, like, well, all right. So we like to just have a 7 year window. But Kenny, for you, I wouldn't really start that though until 59 and a half because you're going to have that fresh 5 year window on all your conversions. So if you're retired, we can talk about doing a one-time conversion and then finishing it all up once you turn 59 and a half, so you don't have all these windows going at one time. But for you, as far as converting to a Roth IRA, I wouldn't be thinking about it because of the taxable income port. But what you can do is start contributing to the Roth TSP or a Roth IRA so that that builds up. And then once you turn 59 and a half or retire, then you can start doing the conversion process. Hope that answers your question, Kenny. Any other questions? Okay, Carmen, I'm retiring October 31, 31. Okay, Halloween retirement. You will come to work as a ghost. I'm 30, yeah, put the question back up. I'm sorry. All right, I will be 67. Is it too late to transfer my TSP to? I have 10 years in. No, it's not too late. We run into people like that all the time, Carmen. But what I would do earlier, Carmen, is start setting up like your Roth IRAs, your traditional IRAs outside of the government early so you could get that window started. That's actually super important. Um, I would start setting those accounts, opening them so that your 5 year window starts. And then once you retire next year, then you can start doing the conversions in 2028 probably because what's going to happen and we can look at it or whoever you work with you want to have them look at what your total income is for October from up until October. Then you're going to get your leave payout and any other you're gonna get those partial checks probably too. And so you got to look at you got to estimate what that total tax year looks like. And we can help with that. Or you just start fresh in 2028 when you know, okay, I know what my retirement numbers are going to be and then you start the conversions from there. But the thing I would start today with is at least getting those accounts open so that 5 year window is already started. So that by the time you turn 60, 75 or 74, or 73, if you were born after 1960, this is going to be 75. And so if you were born before 1960, it's going to be 73 when your RMDs start. But at least you have money already converted over there before that happens so that you reduce how much you have to pay on those RMDs. And Carmen, if you want us to help you walk through that, have no problem helping you navigate all that I just said. Any other questions? Okay. How do I contribute? Kenny, are you a federal employee? Oh, Kenny. So what you do, Kenny? What you do is you go into whatever your payroll is, your payroll software, whether it's MyPay, Employee Express, any of those. They have TSP contribution on the main menu. Then you change the contribution from traditional to TSP, or you alter it. So, like if you're doing 5%, you could do 3 and 2, or 10%, you do 5 and 5. However you want to do it, you change it wherever you go to look at your LES statement, just depending on what agency you're with. Hey, Mark, I started contributing and was still surprised by my taxes, but I'm glad I started. What does the 5 year window provide? Time I can move Roth? No, the 5 year window is just a protection from everybody doing Roth. Everybody just moving money to Roth and quickly taking the money out. So what it is it's almost like it seasons the account. So so how can I put it, man? Because I mean, to me, it doesn't make a whole lot of sense. But what it is it's just when you open up the Roth IRA, they don't want you just going in there. Let's say you roll 100,000 into a Roth IRA immediately. You just can't go in and take the whole 100 out tax free, even though you pay the taxes on it. So they make you sit. They make you sit the money in there for 5 years, or some money in an account in a Roth account for 5 years before you can withdraw it with the tax free benefits. Now, Mark, at your age, your Roth IRA, once you open up one, that 5 year window starts, and you already have one actually. That 5 year window starts, but that 5 year window is just one time, no matter how many Roth IRAs you open up from now on out. And then as your money grows and grows and grows and grows, you're never going to be taxed on that money again. And Mark, we can talk about it in a sec. Anybody else have any other questions? Just oh, what about 5 years between 65 to 2? All right. So that's a good question. And so between 57 and 62 is tricky because from 57 to 59 and a half, if it's tempting to do conversions, but again, every conversion you do starts a fresh 5 year window before 59 and a half because you haven't started taking the full social security yet. You're getting your first supplement. So it's a window. You can, but every conversion you make from 57 to 50, 58, 57, 58, and well, it's really 57 to 58, you're going to start a new window, right? So, you might have one that goes out 6 years, right? Just because, well, total the account might take 6 years because of those two conversions. But it is a good window to do Roth conversions because you're still not getting the whole Social Security payment because the first supplement is about 25% less than what your Social Security check will eventually be. So that's a good question. Whoever asked that. Any other questions? Yeah. So if you're still working and your income is high, converting can be tricky because you could be in a 24% tax bracket, and because you convert now it takes you to 32% while you're still working. And like I said, when you convert while you're working, it's tricky because you're already making the most money that you'll ever make. It's best to do it in that TSP in that tax window from 62 to your RMD age. And so I think that's the last question for the night. Just book a call with the link that our team has put in the chat. You'll also get a survey at the end of the call. Fill out the survey, please. We get good feedback from those. It helps us come up with topics. And next week we'll be talking about FEHB and Medicare. I believe, right, team? I think those are the things we'll be talking about in the health insurance medical arena is what we'll be talking about next week. And like I said, we'll keep doing these. We get a lot of our topics from the surveys y'all do afterwards, plus the assessments that we do on our calls when we meet with clients. And again, how we work, we take you through 4 calls. We do a readiness assessment to see if it's a good fit. We rate you rate yourself on these 5 key areas: income, taxes, how your TSP is invested, uh, long-term care, and your estate, like how well your estate is set up. And so, if you need estate planning, we also do that at Fed Trust and Wills as well. But book a call and we'll take you through our process and do the best we can to support you in your retirement journey.